It's not often the Reserve Bank surprises the entire market, but it did this in its latest OCR review. So what happened and why did it happen? Well, the Reserve Bank did cut the OCR by 0.25%, which was absolutely expected, but what was unexpected that they forecast 2 more cuts by the end of this year. So that caught most economists by surprise. I think only 4 of the 32 economists that are typically surveyed said that the OCR would get to 2.5. So the Reserve Bank now has that as their central forecast. Incidentally, that doesn't mean it will happen, but it's their forecast of what will. What I would say is, they have flip-flopped a bit over recent months, and so to flip-flop again and not cut in the next OCR review and probably the one after that would be unusual. So I think you can say with a reasonable degree of confidence the official cash rate will drop down to 2.5% by the end of the year, but nothing is certain as always. So why the flip-flop? Why did they suddenly become much more bearish on the New Zealand economy? Well, the answer's in the numbers. They've moved from forecasting when they last did a monetary policy statement, when they do a full set of economic forecasts, from expecting GDP, in other words, the size of the economy, to grow, that's what they said in May. Now they're saying it shrunk. So 0.3% up has now become 0.3% down. And so why that impacts the OCR is that means there's spare capacity in the economy and therefore it will be less inflationary. The other interesting thing was they have forecast that inflation will go to or above 3%. And remember their target range is 1 to 3%. So why are they cutting the OCR if that's the case? Well, the acting governor, Christian Hawkesby, was really clear. They can't influence what happens to inflation tomorrow or in a month and 3 months now, but they can influence what happens in 12 to 18 months. So they're really looking through the current surge in price. That's the butter, the beef prices, mainly driven by international influences, and looking at what's going to happen in inflation in 12 to 18 months. And it's all that spare capacity in the economy that's driven that. The thing they expressed surprise on, by the way, was that we're also gloomy here in New Zealand when actually lots of positive things are happening. The export markets, agri and so on, are absolutely booming, and interest rates have fallen a lot. And so, it's sort of a bit of a what's going on here. My view is that it's simply they over-tightened too much in the cycle. We were all in survival mode for a while when interest rates were up at 7%. So now we've sort of come through that. We're not in spend mode yet, but it's sort of getting us back on an even keel. So our view at Squirrel is those interest rate cuts are needed, and with an economy that's been in and out of recession for the best part of 2 years, really I think we should be headed for 2% interest rates, which is below what they're forecasting, but that's another story. So what does that mean for borrowers? Well, we've seen home loan interest rates drop a little bit. The floating rates obviously come down by around 0.25%. Fixed rates have started to drift down, and they tend to do that. You get one bank go a bit lower and then the next bank goes a bit lower than that, and it sort of steps down. But we do think that we'll see mortgage rates for 1, maybe 2 years around about 4.5% over the next month or two. What about house prices? Well, they've been falling actually for the last 2 or 3 months. There are signs of stability. They're not going up or down a lot, but after the big falls we saw a year to 2 years ago, when we saw Auckland and Wellington down sort of almost 20 to 25% plus, they've stabilised. So with immigration low but interest rates falling, a lot less investor demand, rents falling because there's lots of stock on the market, we think the path for house prices is very much sideways. So who's it good for? Well, it's good if you are buying now as a first home buyer especially. It's a real Goldilocks time for first home buyers. Lots of choice because there's lots of places on the market, lots of time to make your decision because there's less competition for houses, lower interest rates. If you're in KiwiSaver, your balance has been going up and so on. So it's a good time. And for people moving, it's a little bit harder because you've got to buy and sell. But always remember you're buying and selling in the same market. So it might not be the price you might have got 2 years ago, but you're buying at that lower price too. For investors, there's lots of investors looking around for good deals, I guess, and that sort of comes when you've got a lot of supply in the market. So all in all, a bit of surprise. I guess the point is, last year we were saying survive till 25. It's become sort of survive in 25, but hopefully from our perspective it all clicks in 26.